Imagine going to bed thinking you've made a brilliant financial bet. You wake up, check your phone, and your entire trading account is completely wiped out. You don't just lose your investment, you owe the broker hundreds of thousands of dollars. This isn't a hypothetical nightmare. It's the brutal reality of a short squeeze, the deadliest trap in the stock market that can destroy wealthy investors and massive hedge funds in a matter of hours. But how does a stock going up cause people to lose everything? To understand a squeeze, you first need to understand short selling. Normal investing is simple. You buy low and sell high. Short selling is the exact opposite. You sell high first and hope to buy low later. When you short a stock, you borrow shares you don't own from your broker and immediately sell them at the current market price. Your goal is for the stock price to plummet. If it drops, you buy the shares back at the lower price, return them to your broker, and keep the difference as pure profit. It sounds like a great way to make money when a company is failing, right? Except there is a massive catch. When you buy a stock conventionally, your risk is limited. If you invest $1,000, the absolute most you can lose is $1,000 if the company goes bankrupt and hits zero. But when you short a stock, the math flips into something terrifying. There is a floor to how low a stock can go, zero, but there is absolutely no ceiling to how high it can climb. If you short a stock at $10, it can theoretically go to 100, 1,000, or even higher. Because of this, your potential losses are mathematically infinite. Now, enter the trap. Imagine a stock that a lot of people think is garbage, so they short it heavily. This is called high short interest. Suddenly, something unexpected happens. Maybe the company releases great earnings, a new product, or a wave of retail investors on internet forums decide to start buying it all at once. The stock price starts going up. The short sellers start panicking. To cut their losses and close their positions, they are forced to do one thing: buy the stock back. And here is the cruel irony. When short sellers buy shares to escape their bad bet, their buying volume adds fuel to the fire. It pushes the stock price even higher. This triggers a domino effect. As the price surges, more short sellers get panicked or hit their margin calls, where the broker steps in and forcibly buys the shares at market price to protect themselves. It becomes a chaotic feedback loop. Buying forces the price up, which forces more buying, which sends the stock into the stratus. We saw this play out in epic proportions in January 2021 with GameStop. Multi-billion-dollar hedge funds had shorted more shares of GameStop than actually existed. When millions of everyday retail investors realized this, they banded together and started buying the stock. The price skyrocketed from less than $20 to an intraday high of over $480. Major hedge funds were caught completely off guard. They were squeezed so violently that some required multi-billion-dollar bailouts just to survive, while retail traders watched their accounts balloon overnight. Short squeezes are proof that the stock market doesn't always care about fundamentals or what a company is actually worth in the short term. It runs on supply, demand, and liquidity. Short selling can be a powerful tool, but if you don't manage your risk with strict stop losses, a short squeeze can destroy your financial life before you even have time to react. If you want to survive in these markets, always respect the squeeze, protect your capital, and never ride a short without an escape plan. If you found this breakdown helpful, hit that like button, subscribe for more trading insights, and let us know in the comments below. Have you ever been caught in a short squeeze?